On the morning an economy begins to fall apart, nothing looks dramatic. The sun comes up, coffee machines hum, trains run. People scroll their phones and complain about emails, but under the surface, one quiet thing has already snapped, and almost nobody sees it. It's not the stock market, not the government, not even the banks, at least not yet. The first thing that breaks is trust measured in hours. Not years, not decades, hours. And once that clock starts ticking, everything else follows. Right now, you live inside a system that only works because everyone believes money will still move tomorrow morning. Salaries, rent, card payments, company payroll, government benefits. Trillions of dollars jumping between accounts every single day like electricity in a grid. You don't see the wires, you just flip the switch. Economic collapse doesn't start when buildings burn or currencies go to zero. It starts when the invisible plumbing that moves money every day begins to hesitate. And hesitation in finance spreads faster than panic. Because modern economies don't run on piles of cash, they run on promises. Short ones. Extremely short ones. To understand what breaks first, you have to understand a weird truth. Most big institutions are constantly borrowing money. Just to survive the night, not to grow, not to invest. To survive until tomorrow. Picture a giant supermarket chain. Thousands of stores, millions of customers. Cash registers ringing all day. It looks rich. Powerful, solid, but behind the scenes, it owes suppliers for yesterday's food deliveries. It owes banks, it owes payroll. Its money comes in waves, but its bills come in right now. So every evening, it borrows short-term money to smooth the gap, just overnight. Then it pays it back to the next day when more sales arrive. Now scale that up to the entire economy. Banks do, T's corporations do this. Investment funds do this. Even governments do this. They borrow today to make it to tomorrow. This is called short-term funding, and it is the heartbeat of the financial system. When an economy starts collapsing, this heartbeat stutters. Not because there's no money in the world, but because nobody wants to be the one who doesn't get paid back in the morning. Let's rewind to how things normally work. Every day, banks lend to each other for very short periods, sometimes just overnight. Companies issue ultra-short debt called commercial paper. Investment firms use repurchase agreements, or repo, which is basically, here's a bond as collateral, lend me cash for a day. It's financial speed dating. Hi, here's collateral, here's cash. See you tomorrow. And for years, everyone assumes tomorrow will be normal. Until something shakes that assumption. Maybe housing prices start falling. Maybe a big fund blows up. Maybe government debt looks shaky. Maybe interest rates jump too fast. The reason doesn't matter as much as the shift in mood. One lender asks a simple question. What if they can T-pay me back tomorrow? That's it. Not a riot, not a crash. A question. And once enough people ask it at the same time, the first thing breaks. Short-term lending freezes. Imagine a massive city where all the water pipes are suddenly still there, but no water flows. The system isn't destroyed. It's companies that looked healthy yesterday suddenly can't roll over their short-term debt. They can't borrow for the night. Not because they're bankrupt, but because lenders are scared. This is where the absurd part begins. A firm can have billions in assets, buildings, inventory, contracts, and still collapse in days. Because it can't get cash for 24 hours. Solvent on paper. Dead in reality. That's the first fracture. Liquidity. Liquidity just means, can you get cash right now? During the early stage of collapse, the answer quietly turns from of course to maybe to no. This happened in 2008. Not when Lehman Brothers officially failed. That was the headline. The movie explosion. The real break started earlier in obscure corners of the system. Most people had never heard of money market funds, repo markets, commercial paper markets. One fund broke the buck. It couldn't maintain its $1 share value. That sounds tiny, technical, boring. It was none of those things. Money market funds were supposed to be as safe as cash. Businesses used them to park money for payroll. When one fund wobbled, companies panicked and pulled money out of others. Suddenly, firms couldn't issue short-term debt. Translation: they couldn't pay next week's bills, not because they were stupid, because the pipe froze. This is the uncomfortable math. Modern economies are leave it on time. If payments stop for a few days, it's not a slowdown, it's a seizure. Let's say large companies miss payroll. Workers don't get paid. They delay rent, credit card bills, car loans. Banks see missed payments rise. They tighten lending. Businesses can't borrow to restock. Shelves thin out. The shock moves from Wall Street to Main Street in days. But at the start, almost nobody notices. Stock markets might dip. News anchors talk about volatility. Officials say fundamentals are strong. Meanwhile, the plumbing is clogging. And here's the irony. Governments and central banks don't wait for collapse. They wait for the funding markets to blink, because they know that's the real tripwire. When central banks panic, they don't rush to buy stocks. They rush to flood short-term funding markets with cash, emergency lending facilities, liquidity backstops, massive repo operations. Why? Because they're trying to restart the heartbeat before the rest of the body shuts down. This reveals something uncomfortable about the global economy. It's not a giant pile of savings funding real activity. It's a giant web of rolling IOUs, constantly renewed. As long as confidence holds, it feels stable, efficient, elegant. When confidence cracks, it looks like a house balanced on spinning plates. Now contrast the hype versus reality. When people imagine economic collapse, they picture hyperinflation, empty stock markets crashing 80%, governments defaulting. Those are late-stage visuals. The real beginning is boring, technical, hidden. A funding auction that doesn't go well. Interest rates on overnight loans spike. Lenders demand better collateral. A few institutions quietly can't refinance. It's like oxygen slowly thinning. You don't notice until you're dizzy. And there's a cruel feedback loop. When short-term funding tightens, institutions sell assets to raise cash. Selling pushes prices down. Lower prices make balance sheets look weaker. Weaker balance sheets scare lenders even more. So they lend less, which forces more selling, which scares everyone further. It's not a collapse driven by reality at first. It's a collapse driven by fear of future reality. The system meets its own expectations. Here's the bigger implication. We built an economy optimized for speed and efficiency, not slack and resilience. Just-in-time supply chains, just-in-time financing, just-in-time liquidity. Great in calm weather, terrifying in a storm. There's very little margin for everyone to get nervous at the same time. And humans, historically, are very good at synchronized nervousness. So it actually breaks first when an economy starts collapsing. Not production, not consumption, not even profits. It's the ability to borrow overnight without thinking. The moment lenders start thinking too hard, the machine jams. Everything else, layoffs, bankruptcies, market crashes, political instability, comes after. Those are consequences. The first crack is invisible and measured in hours, which leads to the uncomfortable question we're left with. If the system only works because everyone assumes tomorrow will be normal, what happens the next time? Too many people at once decide it might not be.